I'm Nick Brunner, Director of Investonline. Welcome to our webinar with Coronation Fund Managers. Thank you to Coronation and to the two senior members of their team for joining us. I'm going to go through our agenda soon. I'm going to give you just a little bit of a overview of Investonline and then just introduce you to our panelists. So I'm going to give you a little intro, and then we've got Chris Cheetham, Coronation Head of Global Market Research, and he's going to talk about the AI industry and the effects on the investment market. Obviously, a lot of the AI shares have done really well. It's a huge new disruption, and I find this is going to be a very interesting session. Chris, thank you very much for joining us. And then the other big one is emerging markets. And we've got Suhail Suleman. He's a portfolio manager. He's going to go over the investment case for emerging markets, opportunities. And that's also been very topical. Obviously, developed markets have done very well. The US market is near all-time highs. And is there better value in emerging markets at the moment? Let me just tell you a little bit about Investonline. We can just flip the next slide. There we go. There's our lovely team. We're a team of 15, 9 professionals, 6 admin. Investonline started 16 years ago. I was a founder, and we've grown significantly. A lot of the concept really is about giving you a much more cost-effective and more efficient service. We really feel by doing video meetings with our clients, we spend a lot more time with them, and it's a lot more cost-effective. We've grown significantly. Most of our client base is in Johannesburg or Gauteng. We operate out of Cape Town, Newlands. And as you can see, our team, it's continued to grow. So just to tell you a little bit about our services, so we do financial planning, so holistic advice, investment management as well. We active manage a portfolio. I separately run a portfolio called the Prosperity Fund. We do direct offshore investing as well, and then tax structuring. So the tax structuring thing is really important holistically in your financial plan. So those are our services that we do. Important, just to bring up some of our partners, is Investonline is independent. So that's really a key issue. We work with a lot of other fund managers that we select. We work closely with them, such as today, as we have, we got Chris and Suhail presenting to you, and to stay on top of their way of thinking and to challenge them as well. And then obviously on a global side, we have a lot of global partners as well that we work with. And then just lastly, just to go through just some of our products, obviously the retirement products, life annuities and living annuities, retirement annuities, preservation funds, and then offshore wrappers, and obviously our offshore platform accounts as well. We've done a few webinars on that with some very attractive products. And then obviously then there's also the local discretionary part, which is your unit trusts, endowments, income funds, money market, and some corporate cash services as well. Right, so that's about us. Right, so we're going to move over to Chris. Chris, thanks a lot for joining us and talking about AI. And we'll have a couple of questions for you after your presentation. Thank you.
Great, thanks, Nick. Thanks for hosting, and thanks to all of you on the call today. Yeah, maybe just to set the scene, to touch on Coronation's global journey. So I think you all know Coronation. We were founded in 1993, but interestingly, we launched our first global active fund in 1999. So, we've been investing offshore for a long period of time. The team is big and well-resourced and settled. We have 50 investment professionals across the team, of which 20 are focused solely on global and emerging markets. And on the far right-hand side, our global AUM now adds up to about $15 billion, which is over a third of Coronation's total assets. So already a sizable franchise within a sizable company. But now on to, I suppose, the purpose of the day today. And I'd like to talk about disruption and AI. And I'd like to start to set the scene again with disruption in global markets. So I think it's really worth drawing your attention to two major trends that we have seen in global equity markets over the last decade. These trends have really changed the market structure, resulting in a lot more share price volatility and reduced market efficiency. And we think both of these factors are hugely advantageous for us as valuation-based long-term investors. So first on the left is the shift to passive, which we obviously have nothing against, but interestingly, passive now exceeds active on a global basis in terms of global AUM. So what does this mean? This really means there are fewer fundamental investors doing the work to value companies, which leads to poor price discovery. So we actually think the price discovery mechanism has partly broken down, especially in the US market, and this results in significant share price volatility. And as active managers, we love volatility. It gives us an opportunity to really buy the shares that we want to own. And then in the middle block, you can really see shrinking time horizon. So I'm sure you've all heard of these sort of short-term focused hedge funds sitting in New York. These are guys betting on the next quarter, not owning a company for the long term. So against the sort of short-term backdrop, we think our long-term focus is by far our biggest asset. We are able to look further out than most of the market when valuing companies, and we're able to cut through short-term noise. Just some brief examples of some stocks that have really come through strongly for us, but just touching on that theme of increased volatility leading to more opportunity for active managers like ourselves. Just Spotify up 7 times off the low. So you really are seeing big moves in global markets. And I think if you're willing to do the work, it can be very advantageous. So now maybe just turning to disruption in our everyday lives before I get to AI. So this chart really shows TV consumption by medium in the United States on the left-hand side, and then global recorded music revenues on the right-hand side. And as you can see, both industries have been totally disrupted by the shift to streaming. So, I don't think this is a big surprise to anyone watching this today. I'm sure all of you have a Spotify and a Netflix account, but this has had a profound negative impact to some of the traditional players in this industry. If you think of a company like Disney, it owns the greatest collection of media brands in the world, but it's a company that has been disrupted. The share price has done nothing for 10 years, which is really a shocking outcome for investors. Our shopping habits also continue to be disrupted, and they continue to shift online, with e-commerce really taking more and more of the retail pie. Against this backdrop, traditional brick and mortar retailers have simply struggled to respond, and we expect this trend of ongoing disruption to continue. And this chart just highlights e-commerce penetration as a percentage of total sales in the US, China, Korea, and Brazil. So all at varying levels, but the direction of travel is clear for all of these markets. Then our habits and preferences are also changing. The chart on the left shows US alcohol consumption per capita over time. And the chart goes all the way back to 1950. I'd like to draw your attention more recently. And the fact is that alcohol consumption is declining. There are multiple reasons for this. I believe the main one being health and wellness, but the reality is younger people are drinking less than older generations. And again, companies, previous high flyers, not deep, but sort of quality names such as Diageo, Heineken, these companies are really just struggling to grow volumes today against this backdrop. On the right-hand side, lastly, you have Morgan Stanley's forecasts for GLP-1 patients in the United States. So these are weight loss drugs. The names you might know would be Wegovy, Mounjaro, or Ozempic, which I think is available locally. But really big growth in the use of these weight loss drugs. And this has a potential to really change how and what we eat, again, with negative implications for the likes of Nestle or Mondelez, and stocks that are traditionally traded on very high multiples. And then this list really shows the 10 largest companies in the world by market capitalization today versus the year 2000. And as you can see, the list today looks totally different to what it looked like 25 years ago, with the exception of Microsoft, which is really a truly remarkable company that has been agile and flexible. But if you look on the left-hand side, right at the bottom, a company like Nokia, I mean, today that's really irrelevant. And you have Apple on the right-hand side towards the top, with a market cap of almost $4 trillion. Similarly, on the left-hand side, you have Intel. Today, it's off the list, having really ceded its ability in producing leading-edge semiconductor chips to Taiwan's TSMC, which you see on the right-hand side. So I think disruption is a reality. And it's hard for companies to stay at the top of their game over multiple years. And this will only be amplified by AI. So obviously, no discussion on disruption is complete without a section on AI or artificial intelligence. And as you can see on the left-hand side, the leaders of the world's biggest and most powerful companies are absolutely effusive as to the potential of AI. If you read the top quote from Alphabet or Google's CEO, Sundar Pichai, the opportunity with AI is as big as it gets. But if you turn to the right-hand side, there are extreme and divergent views here, from robots running in the street to users like myself sometimes complaining about inaccurate information or trying to develop a picture of a pigeon that turns out to be a butterfly. But I think the reality is these AI tools are improving dramatically every day. So the truth likely is somewhere in the middle of these two pictures, but it is a story of ongoing adoption and improvement. So maybe to start or to level set, what is AI? I actually asked ChatGPT this question, and the answer it gave me was AI enables machines to think and act intelligently, performing tasks that normally require human intelligence. So it analyzes historical data to make predictions around the future. And the reality is that AI has actually been around for a long time, since the 1950s. So why now the recent interest? And I think for us as consumers, the launch of ChatGPT in 2022 really thrust AI into a consumer limelight. For the first time, large language models could consume huge quantities of unstructured information. But very importantly, these models could actually understand plain written language. So if you think of what that means for us as users, it really changed the way that we as humans interact with machines, and obviously dramatically expanding who can use AI and opening up a large number of potential use cases. And early use cases are already quite compelling. If you look on the left-hand side of the slide, in coding and software development, a company like Microsoft is using AI to write 30% of its code already, and that's only growing. Within customer service, I'm sure you all know Salesforce. Salesforce is using AI to respond to hundreds of thousands of online customer queries with a reported 80% resolution rate. And in media production, James Cameron, the acclaimed director behind the likes of the Avatar film, he actually recently stated in an interview that AI could reduce the budget of blockbuster films by up to 50%. So I think more importantly, across industries, we really see the potential for companies to become more efficient. From simply summarizing long documents to drafting letters, to more advanced search, to AI agents potentially acting like your personal interns, automating large numbers of routine tasks. At Coronation, we're using AI extensively in our process. I won't get too deep into it, but we use some software called AlphaSense, which really sucks in data from multiple sources, including financial statements, broker notes, as well as news sites. And an easy, tangible example is something that I search. If I was asked, what would happen to Disney's parks business during a recession? Historically, I would have to probably go and first Google when was the last year's recession. I'd have to trawl through the financial statements. It might take an hour or two, where using AlphaSense, you can really type in your question within 30 seconds. It's giving you a great answer, and importantly, with links to source materials. So, we believe for our industry especially, there's really a lot of really compelling use cases. And this is obviously before we get to the likes of robotics and autonomous vehicles. These are very nascent areas, but areas that our team is doing a lot of work on. So I'm sure top of mind is the question, will AI take our jobs? And I think to answer this question, one really needs to look back at history, the reality is that technological disruption is nothing new. It's happened consistently over the years. And people today are richer, we are living longer, and we are working in better jobs, and we are working in more jobs in terms of quantity than ever before. 150 years ago, everyone was effectively a farmer, a miner, or a factory worker. There's nothing wrong with that, but the nature of jobs has expanded, and 150 years ago, you wouldn't have had a 2-day weekend either, so I think jobs have got better and easier. Going back 150 years, you had children going down the mines in the UK. Things like that would be absolutely unthinkable today. So we think AI will continue this trend. We think it will drive efficiency and productivity gains. It will certainly disrupt many industries. If you think of software coding already, if you think of some paralegal work, but it will create new roles elsewhere. And we believe quite firmly in our job in financial services. If used properly, it's an amazing tool to make us all more efficient and productive. So are we currently seeing an AI bubble? Another question we get quite a lot. I think the amounts being invested are absolutely staggering. On the left-hand side, you can see the annual capital expenditure from the 4 US companies really leading the Western AI investment charge, up 6x over this period, now spending over $400 billion a year, so massive amounts. On the left-hand side, you can see NVIDIA revenues versus Unilever. Clearly no relation between these two companies, but I think this captures what we're seeing on the ground. NVIDIA revenues, and think about this in the context of your own businesses. Since 2019, revenues up 18x, over $200 billion. And I mean, the scale and pace of this is unprecedented in the history of financial markets. And I'm sure, as you all know, NVIDIA is now the biggest company in the world due to its leading position selling AI chips into the world's data centers, $4.5 trillion market cap. So there's clearly a lot of excitement in the space. And this is also true in the private markets, where OpenAI, which is behind ChatGPT, recently hit a $500 billion valuation, with the likes of xAI and Anthropic over the $150 billion mark. And then on top of these valuations, there's also a lot of circularity to this industry funding. So what you have is NVIDIA at the top investing $100 billion in OpenAI, and then OpenAI turning around and agreeing to buy tens or hundreds of billions of chips from NVIDIA. And OpenAI is actually at the center of a lot of these deals. It's had deals in the hundreds of billions of dollars with Broadcom, with Oracle, with Stargate. So to be honest, this is all quite confusing, and definitely it is cause for concern in certain segments of the market, not all. So this chart just expands on my chart earlier of the 10 biggest companies in the world. On the left-hand side, you can really see today 9 out of 10 of the world's biggest companies are related somehow to AI. And this has really driven an increased and unhealthy levels of concentration in the US market, as you can see on the right-hand side. Again, we think this high level of concentration is very advantageous to active stock pickers, but I think that's a topic for another day. So there's clearly a lot of excitement around AI and AI-influenced stocks. I think there's no doubt about that. But then to conclude on the question, are we in the AI bubble? Usage is growing dramatically, and it is still so early in terms of use cases. If you think of companies around the world, they are barely even scratching the surface in terms of what AI can do for them. And there's also no chip excess capacity. Every chip that NVIDIA can produce is being taken up and being used. This chart is actually a bit outdated now, but I think the story holds true. It really just shows the number of tokens, which is proxy for usage across Google's various AI-related properties. And it doubled over 2 months after taking a year to double previously. So you really are seeing usage, accelerating usage off a very, very low base. So rounding this out, we think there are definitely hypes in certain parts of the market, but we are still seeing some attractive opportunities in the space. I won't spend long on the slide, but our AI exposure is via semiconductors on the left-hand side, and then cloud players below that, names like Amazon, Microsoft, partly cloud, not only cloud. Amazon obviously has an e-commerce business as well, Microsoft software. But I think the broader point is that we are effectively backing the picks and shovels of the AI boom and not betting on any one winner in terms of which application actually emerges as a long-term winner. And just important to note that we are not betting the farm on this or any other trend. Coronation, our exposure is always diversified. As you can see, semis comprises 11% of our global equity select fund, with cloud-related names a further 8%. So I'd like to just briefly touch on the disruption to quality and narratives. So quality is clearly a very popular investing style. It's a term that's used frequently in our industry, but it's also a term that is never really fully explained or quantified. And it's also based on backward-looking metrics. So we feel that in the world of change, a world of disruption that will be accelerated by AI, we think the reliance on backward-looking and outdated definitions is lazy and dangerous. So just one quick slide to highlight this. This slide really shows a selection of traditional elite quality names, names like Estee Lauder, Nike, Adobe, Nestle, Diageo, and they've all underperformed significantly over the last 5 years. And the same is true for 8 out of 10 of these names over 10 years. So there are many reasons for this. I won't get into this, but we think it all comes down to disruption. These names have all been disrupted in one way or another. So at Coronation, we do strongly believe that traditional quality metrics are important, but they are backward looking. And quite simply, past glory does not guarantee future success. In the world of change, additional questions are necessary. So wrapping this up, and it's probably a term you're going to hear more from us, but we prefer to rather focus our attention on identifying what we call winning businesses. These are businesses that are fit for purpose in a modern world. They're on the right side of technological change and have a culture of innovation. These are businesses that really are looking forward, not backward only. So, some examples you can see on the right-hand side. And I think to summarize, in the world of change, investors need to be forward-looking. Reliance on backward-looking metrics like quality in a world of disruption, a world of technological change, we believe that's dangerous. As many of these companies have already been disrupted. So with that, Nick, I'll hand back to you for some questions. Apologies, I think I went slightly over my time limit.
Cool.
I won't touch on that, but it just shows the sort of key equity exposures of our equity fund.
That's fine.
There
Cool, great.
Sure.
Great, thanks, Chris. Well, it's really interesting. So maybe just to dumb it down. So in AI, effectively, it's just really sped up the processing of information significantly. And obviously that's making things a lot more efficient. So maybe with that, I don't know, that kind of backdrop, job losses, that's the layman, we always talk about that. So what's the future going to look like? And we've had these other disruptions, the slide you put up earlier on, obviously the internet coming out. What's the view, or what studies maybe have you guys seen about jobs going forward and potential losses to AI?
Yeah, Nick, I think looking back at history, as I mentioned, any big technological leap, even the launch of the smartphone, the launch of the internet, job productivity has continued to grow, as have job numbers. So I made the point earlier that I think we're all working in better jobs today than we were 150 years ago, and this likely continues. I do think some industries are more at risk than others. If you think maybe paying a paralegal 2,000 Rand an hour to sort of sort through documents and draft a will or that sort of thing, you can use AI efficiently to do that. The same is true in coding. We've seen massive advances there, but generally looking back at history, I think new technologies actually expand the number of jobs available. And I think in our industry, it's a great sort of assistant. So I would think of it more as a sort of, any one of you out there can have 1, 10, 100, 1,000 of your own interns. We always think interns, they might be really useless at first, but they're learning all the time and increasingly able to perform better and better tasks. So whether it's drafting client emails or better search or summarizing or following up on leads from a CRM perspective, yeah, I think I'm quite relaxed in terms of our industry. And lastly, maybe our kids will only work 3 days a week. Who knows, in 30 years' time. So I think that has been the direction to travel, which...
Yeah, I think that's probably what most of us are thinking about our poor kids and then what kind of jobs are they going to have one day.
I think our lucky kids, because I think they'll probably have better jobs and they'll work 2.5 days a week.
Yeah. Maybe just for us to understand a bit more about AI and the revenue generation. So we know NVIDIA makes, these special chips, they make money out of that. And then there's ChatGPT, and that's just a much quicker search through the internet. What other areas or products come around with generating revenue from AI?
So this is one of the key questions, considering the hundreds of billions leading up to trillions that's being spent. So you mentioned NVIDIA. NVIDIA is designing the chips, and then effectively 90% of the world's leading edge chips are made by Taiwan's TSMC, which we hold in the fund. So we actually think TSMC is one of the most important companies in the world. I'm sure Suhail will probably touch on that as well. But in terms of revenue, I think you have to think about new applications. And I touched on what we're using AI for in our own investment process, and it really can be simple things, but really speeding up our day-to-day lives. But you also have to think of it infused into everyday technology applications. So I'm sure most of you are Spotify users. Spotify's been using AI for years, to get better in terms of song recommendations, what ads to serve you. So that's just one example. You all are probably on social media using Instagram. Hopefully not, but I'm sure a lot of people are using Instagram. So AI is being used to do better target ads, better target what posts you're seeing. So the question is quite broad in terms of monetization. I think for some of these big leading businesses that you saw in the top 10 that are multi-trillion-dollar companies, I think there's a defensive aspect to it. They're using AI, spending on AI to improve the value of their existing services, Meta, Microsoft Copilot. And then I think there's a whole host of new businesses that will launch that we wouldn't have thought of 5 years ago. So it is quite broad. I think you'll see broad monetization levers emerging. Things we actually haven't thought of, in addition to existing businesses just getting better and better, and other tools that make us more efficient.
Yeah. The mind boggles, eh? All right, now, Chris, I'm going to put you on the spot now. So obviously a lot of questions or talk about, how well these shares have done, and obviously the US market's at all-time high. A lot of it being driven up by these AI-related companies, Magnificent Seven, and the question is always how much of this, all the good news, is priced into these shares. Should we not rather be selling them now? So one of your slides in the beginning, we showed the top 10 slides, and we had Microsoft 20 years ago, 25 years ago in the top 10. And out of those darling slides, companies, thanks, Chris, for going back to those 20 years ago, those were the darlings. You only have Microsoft there. Now, 25 years on, Microsoft is the only one that survived to be in the top 10. So if we look at that list now in 2025, how many of those companies do you think will be in that same list in 20 years' time?
Sure. So it's quite a tricky question. I think the key as investors is firstly just, I think work in a sort of low ego team environment or culture and acknowledge that we don't know. So I think that's the point that I mentioned about identifying winning businesses. These are flexible and adaptable businesses, but I think in a world of disruption, investors really need to be able to do the same. So we are always we're encouraging the team constantly, to have conviction where it's due, but also to change your mind. So that's really a long way of saying I don't know. I would look at some companies which I think have shown the ability to be flexible and adaptive or adaptable. And, Microsoft does stand out. I would say Tesla, even though we disagree with the valuation, that's a story for another day, but Tesla's also shown its ability to keep investing in new future-facing industries like robotics, autonomous vehicles, battery storage, energy storage. So I can't really give you an answer besides we'll have to chat in 25 years' time, but I think investors really need to remain pragmatic and open-minded.
Yeah. Yeah, listen, I know it's a tough one. I know if I just look at that list in 2000, Cisco jumps to mind. It took Cisco about another 20 years after it collapsed in 2000 for investors to get their value back again. So I know it's hard, and that's the joy of investing is all this new technology and how it's going to make us a lot more efficient going forward.
Yeah, exactly.
Yeah. Okay, Chris, thank you very much. Really appreciate your insights. We're going to move on now to emerging markets. And Suhail Suleman, who's a portfolio manager in the emerging market team. Yeah, Suhail's going to get into the hot seat there. Suhail, thanks for joining us.
Pleasure. Good to see you.
I'm really looking forward to hearing about your emerging markets. And I mean, is this really the area that's where there's much more attractive value given how developed markets have done really well, where it is? So yeah, we're looking forward to hearing where those opportunities might be. Thanks.
Great. Thanks, and good morning, everyone. We don't have quite as many of these world-beating, sexy businesses that are taking over the world in emerging markets. That's not to say there isn't a tremendous amount of innovation going on in emerging markets, particularly in China and in fields like AI, but it's not quite as top of mind. And a lot of it is also in private markets. So, the big AI players in China are typically in the likes of Alibaba, Baidu, Tencent, where it's a small part of the overall mix. But I just wanted to kind of paint the backdrop of what's been happening in emerging markets, because we launched in 2008. We launched the retail fund at the end of 2007 and the institutional fund in 2008. And, unfortunately, when you look at returns over the last sort of 20 years, we started investing in emerging market 20 years ago when they were very much in vogue. It was the height of the commodity bubble. South Africa was going through an incredible time at the time. I mean, I remember when I entered the industry, the amount of capital flowing into emerging markets, we were running a budget surplus, which seems like a lifetime ago, and being criticized for it at the tail end of the Mbeki administration. And really what happened is that after the quick rebound post the GFC, we've just seen this persistent underperformance of the asset class relative to broader global markets, whether you look at MSCI Equi, the S&P 500, or of course, I mean, the most pronounced underperformance has been against the NASDAQ. And that just tells you how tech-driven a large part of these tremendous returns have been for global investors. Now, you'd have done okay owning emerging markets over that time, particularly if you were South African and you're looking at the returns of EM versus holding South African stocks. But you would have been much better off investing in global markets without a doubt. So, like, what's changed? Why would you bother with emerging markets on a forward-looking basis? What can you get that's different in emerging markets compared to what you can get in global markets? And I think the key is that the structure of EMs have changed significantly in the last 15, 20 years. Just to give you an idea, when we launched, as you would expect, since it was around the peak of the commodity bubble, Brazil was actually the largest weight in the benchmark back then. So if you were buying an EM product, and I'm talking about a passive product, which is just mimicking the benchmark, you would have had Brazil as your largest exposure. South Africa was quite material. We were double-digit weight. Countries like Saudi Arabia weren't even in the EM index at the time. Russia was quite material. And really what you've seen is you've had this locus shifting away. The focus is shifting away from the older emerging markets, the ones which were a little bit more developed, which were already middle income, which were more commodity dependent, and it's shifted very much towards East Asia. And in the process now, China is the biggest of the countries in the EM universe. Taiwan is second largest, India is third, South Korea is there. So if you buy an EM product today, you've got roughly 3/4 of your money tied up in those four countries. And they're very different economically, politically, socially from the likes of South Africa, Brazil, Turkey, or Russia, or any of these other countries. But it goes some way to explaining why EMs have underperformed so much over the last 15, 20 years. So you've had the commodity bubble bursting. And if you had whatever 15% of your fund in Brazil, and Brazil's now 5%, that's 10% that you've lost in terms of weighting, and that's a big underperformance. And because this has taken place over the period of 20 years, the underperformance has become more pronounced. Now, the opposite takes place in developed markets, where I think if we went back 15, 20 years ago, the US was sort of 40, 45% of global benchmarks, and now today it's closer to 70, 75%. So really one big winning country has shot the lights out and given huge returns for global investors. And you've had the opposite happen in emerging markets, with the countries that had done very well in the 10, 15 years prior to the GFC just kind of fell by the wayside. Now, this would be a problem if there was nothing to replace them. Our argument has been that actually the pool of capital now in places like China, India, Korea, Taiwan is actually quite significant, and the opportunity set for investors there is quite significant as well. And you've seen our exposure in these countries has gone up over time, as well as we've chased what we think are the best businesses out there within these countries. That being said, we still have material exposure to places like Brazil. I mean, Chris was here. He covers Mercado Libre, whose biggest market is Brazil. We've got Nubank, which is a Capitec type startup bank in Brazil, which we'll touch on very briefly later. You can see here also how the big company weights have changed over the time. So when we launched Petrobras, which is Brazil's sort of state-owned oil producer, which is listed, was the largest stock in the EM index. Gazprom, which is notorious now as being the major gas supplier for Western Europe and an arm of the Russian state, was the second largest. I mean, if you go through these top 20 here, there wasn't a lot of businesses which you would look at as being really world-beating businesses you'd expect to see around in 10, 15 years on a forward-looking basis. And if you look at our portfolio back then, it looked very different from this year. There wasn't a lot of overlap between our portfolio and these top 10 weights in the benchmark. And it was sort of less concentrated then. It was 31% from the top 20. And as you can see, over time, it's become more concentrated now. So reflecting a little bit of what we're seeing in developed markets, where the top weights are far more important. But what's very clear is that what was previously sort of high capital, low return, commodity-driven type industries, which dominated in 2008, now, if you look today, it has also become a lot more tech-focused. So TSMC, as Chris mentioned, they basically make the most advanced chips in the world. In my view, it's the most important company in the world. Without them, nothing gets done. Not our phones, not our data centers, not the cloud providers. And again, nothing works without TSMC. But it's 10.9% of the benchmark. It also sits in Taiwan, which is 100 kilometers away from China, and China covers Taiwan. So it's never an easy answer to give you as to whether this is something should be 5, 10, 15% of your portfolio. If you believe there's zero risk of invasion of Taiwan by China, then by all means have 15, 20% of your portfolio in there. But we've seen that often doesn't turn out to be a prudent allocation of capital. And I think what's quite great now when you look at these sort of top 10 in emerging markets, I mean, other than Reliance Industries, which does refining and has India's largest mobile phone network, like most of these businesses here are great businesses with 10, 15, 20 years of earnings growth ahead of them. It doesn't mean they're cheap. It doesn't mean we're going to own all of them. But I think the quality of the benchmark, the quality of the asset class has improved materially. And that's a very positive development for the asset class. And it's been quite pronounced. Like just in the last 5 years, you've seen here, Alibaba has a bit fallen a bit from grace. But that was almost 9% of the benchmark at the height of the sort of post-COVID recovery in markets. So our argument is that the asset class now is more attractive than it was 10, 15 years ago because of changes in in the big weights and the companies that make it up, and also in terms of the quality, that intangible characteristic that Chris was referring to. The quality of the benchmark is much better than it was back then. It's a huge index. There's 1,500 stocks in the benchmark, and obviously our job is to go out there and find the stocks which we believe got the highest level of potential upside on a risk-adjusted basis, and build a portfolio on that basis. Why would you choose us for doing emerging markets? I think for the same reasons that Chris spoke about earlier. We've got a large integrated team which does emerging markets, global, and SA all under one roof. We pick the best ideas across all the asset classes and put them into our portfolio. And our analysts are trained to look at profit in any country, in any sector, anywhere in the world. So even the South African analysts are looking at global stocks today. An emerging market analyst is looking at global stocks, and the global team analyst is looking at emerging market stocks. The track record of the fund has been good. We've had 1 or 2 hiccups along the way, but generally it's been consistent compounding of capital and outperformance. In a world where active managers have really struggled to add value, 2% alpha since inception doesn't seem like a lot, but when you compound that over now 17 years since we launched, it's quite a big uplift in value add for your investors. And then I think most importantly, we think despite the very strong returns from emerging markets over the last year, the portfolio itself is very attractive. So today, on average, there's about 52% upside in the portfolio, and the long-term average has been around 40 to 45%. So the portfolio is still cheaper than the long-term history, which is very positive for forward-looking returns. I touched briefly on performance. As I said, since inception, alpha 2.1%. The near-term numbers have been very, very good. So I think over 3 years now, after having gone through the very tough period when Russia was written down to zero in February 2022, we had a tough period in the last 9 months of 21 and the first 6 months of 2022, and we've come through that now with very strong performance. We want to get the 5-year numbers strongly positive as well, because we think 5 years and longer is the right way to measure your value add for investors over meaningful periods of time. And in the fullness of time, we believe we'll cure that 5-year number as well. But the long-term numbers are looking good now. And since inception, as I said, 2.1% is a very good performance. Like many of our peers who've been around for as long as we have struggled to generate consistent alpha since inception. And what you have seen is, some of the active managers did very well for short periods of time, and then they go through periods of -15, -20% alpha over 1 year. It's very hard to cure that. And we think our competition is not really other active managers. We think our competition is sorry, I'm not dismissing competition. What I'm saying is, I think what's very important is that us and global, we're competing against passive. We want active managers to add value for clients, because when active managers add value for clients, money flows away from passive and into active asset managers, and that's very good for the industry. And so just like in global, we've seen a huge increase in the amount of money going into passive in emerging markets. And what that means is that the opportunity for value add through deep proprietary research, and even today now using AI enhancements to enhance our productivity is quite strong. And that's why we're more positive going forward that we'll be able to add value for clients. Because when we started doing this year, there might have been 10% in passive, and today you're sort of sitting at 40-50% in passive in emerging markets. So there's a lot of scope for price discovery to create value for your clients. I'm sure you're interested to know what we own in the portfolio. We group them together into these categories, but we don't build portfolios to fit into a single theme. We don't look at wanting to have 10% in India and then going about making sure that we have 10% in India. Every stock in here is in here because on a risk-adjusted basis, the upside to fair value from the current share price is quite compelling. But you will see a couple of similarities between the stocks that we own. So we think that digital disruption is a big opportunity in emerging markets. What you saw in Chris's slides here about the likes of Unilever and how they've underperformed over long periods of time, we're seeing the same thing happening in emerging markets here. Food delivery is quite prominent in the portfolio. Digital banking is quite prominent in the portfolio. And really what's happening is that you've got two kickers. You've got rising incomes, rising propensity to spend, and then you've got this shift from offline into online, whether it's in foods, restaurants, in e-commerce. It's playing out across the board in emerging markets. And in some cases, emerging markets are actually quite far ahead of developed markets. You know, to give you some examples, in places like Korea, e-commerce penetration is much higher than it is in the US. In places like China, it's around 40% e-commerce penetration. And the reason is you don't have these large established big box retailers to compete against. So, you know, a consumer in China doesn't have a Walmart or a Best Buy or a Costco or a Sam's Club to go to compete with against e-commerce. You know, so for them, Alibaba, JD, Pinduoduo, Meituan, they're the ones they're going to want to shop from because your alternative is actually quite a poor shopping experience. And that's why you've seen e-commerce penetration rise much faster in emerging markets than you've seen in the places like the US and Western Europe, because you don't have these established incumbents to compete against. We like what we term global leaders, businesses which we think are like miles ahead of the competitors, have just got such a large lead over the competitors that with the amount of money they make and the amount that they reinvest in growing the business and keeping their technological edge, they'll stay ahead of their peers. So TSMC and ASML will fit into their category. Those are the two most important stocks in the chip making industry. We've also got Airbus, which you know, sells probably 2/3 of their planes to emerging market airlines. And then we've got the likes of SK Hynix, which is a memory maker, but is now the leader in high bandwidth memory, which feeds into the GPUs that the likes of NVIDIA and Amazon and Google would use in their data centers. Just highlighting a couple of the perhaps lesser well-known, what we term the Fabulous Five. These are stocks outside of China, which we believe are, you know, big long-term winners in the industry. Mercado Libre is e-commerce in Latin America. Brazil is their biggest market in terms of revenue. Grab is food delivery, and Uber ride-hailing in Southeast Asia. So that's Indonesia, Singapore, Thailand, Philippines, Taiwan. Nubank, which we'll touch on very briefly just now, is the a digital bank in Latin America. Biggest market is Brazil. Coupang is e-commerce in Korea and now increasingly in Taiwan as well. And then C has a gaming business, so video games, mobile games, and they've used that to launch an e-commerce platform which is across Southeast Asia and in Brazil. Now, these businesses, when we first started buying them, after they fell off in early 2022, you know, the EMs fell off significantly after the COVID bounce. Most of them were losing money. No one wanted to own them, and you know, we took a long-term view on what they would think they would. Well, first we believed they'd be long-term winners, that they'd be much more profitable in the fullness of time, and that they were undervalued. And we bought all of them in varying sizes. And today you can see a couple of years later, all of them are profitable and increasingly more profitable with the passage of time. I mean, to illustrate, I think Mercado Libre went from $1,500 to $400 in the post-COVID sell-off. Grab went from $8-9 down to $3. Nubank went from $13 down to $4.50. Coupang went from mid-30s, Chris, down to $12-13. Yeah, and then C, which was a glory stock pre-COVID, fell off just before COVID, went up tenfold, and went back down to $40. You know, a 90% decline. You know, today it's at $160-180 a share. So, you know, if you would take a long-term view, you really can find great buying opportunities, and these have come through strongly for us in the portfolio today, and they all remain holdings in the portfolio because we still believe that they're materially undervalued. I mentioned TSMC. It's 11% of the benchmark. It's 7% in our fund. We would like to be bigger, but in a portfolio, unfortunately, we don't run a hedge fund. It has to add up to 100% in terms of long. So if we had 9-10% in TSMC, we'll get the China-Taiwan invasion. I mean, that's 3% of fund that we couldn't allocate elsewhere in stocks which we believe would have potentially more upside for us in the portfolio. Nubank in Brazil is the second largest, and then Prosus and Naspers combined are around 7% of fund, which reflects our view that Tencent's probably the best business in China on a long-term view. Certainly more so than any other one that we've come across. The long-term upside to fair value, as I said, 52% versus the sort of mid-40s long-term average. And it never falls to maybe in the short term it might if markets move very quickly, but typically it never sits in the sort of 30% range for long periods of time, because once stocks start approaching fair value, we're typically reducing them and recycling capital into stocks which we believe are more undervalued. And so as a result, it very rarely falls below that 40% level. There's a decent long-term I won't say correlation, but sort of relationship between times when the portfolio is materially undervalued and periods of significant outperformance going forward. If you plotted our alpha cycle relative to this year, you will see a reasonably strong relationship between the two. Today we've got nothing in domestic South Africa. That's 2.8% is in Naspers. If you add that to China, because effectively it's a little bit Tencent and Hong Kong, we're kind of similar to what the weight for China is in the benchmark. I think the big difference is in Taiwan. Other than TSMC, we don't have much in Taiwan. The Taiwanese market has absolutely shot the lights out because all these sort of small makers of widgets that go into smartphones and data centers and the guys who make racks for servers have all gone up significantly. So Taiwan has gone from 13% weight a couple of years ago to almost 20% now. India, after a tough year and a half, has gone from almost 20% in the benchmark to 15. Today we are at 12.5. So we were massively underweight in India, and India's done poorly. So it's been a big source of alpha for us over the last year. And then Brazil, it shows 12.6%. But most of the stocks that we hold in Brazil operate across much of Latin America. So Mercado Libre, as I mentioned, is Brazil, Mexico, Argentina. Nubank is Brazil, Mexico, Colombia. And so the actual domestic Brazil exposure is much smaller than that. And then these sort of ones you see up here in Western Europe are the multinationals, which are making the majority of the revenue in emerging markets and which meet our criteria as a result of that. And that's capped at 15% of fund. And today it's at around 11.5, 12% of fund. Very briefly, I thought the listeners might find this interesting because of the parallels with Capitec. So, much like in South Africa, you had this well-established, entrenched oligopoly of banks which were milking the Brazilian consumer. Nubank launched with a totally digital offering, and they've now grown to 107 million customers in Brazil. They bank 60% of the adult population. They launched in Mexico a couple of years later, and Colombia after that. They're very early on in terms of the development in Mexico and Colombia, but we believe those markets they can do what they've achieved in Brazil. Because they're totally digital, they've got a very low cost to serve. And what's happened is that the incumbent banks were earning ROEs of 17, 18, 19%. The cost of capital in Brazil is very high. You didn't need to lend to people. If you were sitting with excess liquidity on your balance sheet, you didn't need to lend to people to make money because you could stick your money into government bonds and earn 15%. And so as a result, the Brazilian consumer was basically getting overcharged, underserviced by the banks. And this management team here saw that as a big opportunity to launch all-inclusive banking operations in Brazil. It IPO'd in late 2021. We didn't own it. I don't know if you could see this cursor that I'm running on the screen here, but it fell off precipitously when markets fell off, and we kind of built our initial position here, kept it for a while, and then the execution really improved. They started delivering, profits started exploding, customers were coming on, everything was going really well. And even though the share price went up, we actually added to the position because now your conviction levels are increasing because the operational performance is improving significantly. And today at sort of $15, it's a 5% position in the fund. We think it's worth the mid 20s, so there's still substantial upside. It's very hard for anyone to take them on now in Brazil because they've just got this massive scale advantage. As I said, more than half the adults in Brazil are banking with them. The big opportunity really is over here. So the average revenue per customer today is only $12.20. And you can see here, once someone's been with them for sort of 4 or 5 years, the average revenue that these customers give them is, you know, $18, $23, $27. But the large majority of their customers are actually in this cohort here. They've been with them for sort of 1 to 3 years, and they're not actually contributing to revenue. So if you fast forward this a couple of years later, you can just see what happens to revenue. I mean, they're not even doing mortgages yet, which is the biggest ticket item that you can get. You know, you could have, you know, out of that 107 million customers, I would say 60 to 70 million are in this region here on the left. And what happens to your profits when that revenue goes up 8, 9 times over the next couple of years? Today, you can see in Mexico, where they've just started out here, they've got a minuscule share, and even in Brazil, where they bank over half of the adults in the population, their share of the profit pool is very, very low. So, you know, we think there's a big long-term opportunity here, and the parallel in South Africa would be Capitec and what they've achieved here. I mean, 20 years ago, the banks were under pressure to roll out low-cost bank accounts. They had the Mzansi accounts that they were supposed to roll out here. These things just died because Capitec made them completely irrelevant with the passage of time. So I think I've also exceeded my time here, and I'll stop there and leave the last couple of minutes for Q&A.
Cool, thanks. Suhail, thank you very much. Just a couple of, you know, obviously it's a big universe, emerging markets. Just wanted to get your feeling, if you had to make a call on some of the emerging market, which country do you think would surprise the most on the upside from a market value perspective over the next 5 years?
So I mean, I think we should restrict the discussion to the big, like the material ones where you can add value. Like I think a Brazil or a South Africa, you know, if they double, it's great, but it only gets you an extra 5% return. If you look at the 4 big markets, Taiwan, Korea, India, and China. India, despite the recent troubles, is still a little bit on the pricey side. So, you know, seeing that one just shoot the lights out from here is more difficult to see. I think China is probably one where expectations are still quite low, and it's because everyone's worried about the demographics and the property crisis and you know, trade. You know, the leading businesses in China, they're so innovative, they're so cutthroat, they're so dead set on improving that flywheel of getting costs down, improving the quality of the product, reinvesting and killing the competition. I think China is probably the one that would stand out for me as one where you could look back in a couple of years' time, and many of the great businesses in China will have shot the lights out. I mean, no one can compete with them in solar, in batteries. No one can compete with them in gaming, in e-commerce, in food delivery, in ride-hailing, in quick commerce. It's just the list of businesses there which are you know, just miles ahead of the Western competition, is probably more so than any other emerging markets. And China is still quite cheap. Like if you look at MSCI China, despite the rebound since September last year when they had their big stimulus, it's still sort of on 13 times forward, which is not expensive. Even something like Alibaba, which is double this year, it's been one that no one wanted to own, and now there's a frenzy to get invested in it because of the investment in cloud. Even something like Alibaba is still only on sort of 15 times forward earnings 1 year. Now you compare that to the multiples on a Microsoft or a Google or a Meta or whatever. I mean, it is very compelling. And that's not to say there aren't a lot of dud companies in China, but you know, they've kind of almost become irrelevant now because they're so small now in the investment universe.
Okay. Just India. I know that you guys were underweight India for some time, and it looks like you've upped your weighting quite a bit more recently. I mean, what has the change been there?
Yeah, so I mean, we've bought in the last year Zomato and Swiggy. Swiggy only IPO'd in December. That's part owned by Prosus. They both food delivery and quick commerce, and you know, we think the market opportunity there is, you know, I think online grocery penetration there is like 1%, and this could easily be 15-20% in a decade or two from now, because your competition there are effectively a bunch of spaza shops. You know, you're not competing against established grocers, you're competing against very informal trade there, and you know, they're just constantly investing in getting the cost of delivery down, and improving the quality of the assortment that the customers can experience. So both of those are in the fund. And these are not like cheap if you look at near-term metrics. I mean, Zomato's 1 year forward PE, I think, is over 100 times, and Swiggy's is even higher. So you'll be really taking a long-term view that 5-10 years from now, you constantly, if you become consistently profitable and then you grow your earnings 25-30% per year, that 100 rating becomes a 15 rating 10 years from now. And what happens to your profits over that period? Your earnings, they just compound year after year after year. The return that you can get from that is quite significant. So the two of them combined are about 3.5% of fund. We've upped our exposure to HDFC Bank and ICICI because the state banks are struggling at the moment, with the exception of the biggest one, SBI. And then it's also a function of what the index has done. So India, as I said, was 20% of the benchmark. India's down. The benchmark stocks in India are down on average 20% over the year, and the rest of EM is up, and so its weight has shrunk. And our stocks that we own in India actually went up over the last year. And so the combination of those two factors has resulted in the underweight narrowing. But we are still technically underweight because large parts of the Indian market are very, very expensive. Like to own a Unilever equivalent in India, you've got to pay 60-70 times earnings. And like these aren't companies that are going to give you 25-30% earnings growth for the next 10-15 years. They're growing, but they're growing at 10-15% per year. It's not enough to justify that rating.
All right, then I'm going to have to just ask you. I know that the fund took a bit of pain with some Russian assets that had to be written down a few years ago. Does the fund still own any of these assets?
So, I mean, your clients would mostly be invested in Gemflex. So Gemflex was able to exit everything in Russia. So there's nothing left in Russia in Gemflex. And it was one of the first ones to exit because of SA's, and I say this with a sense of shame, friendly status with Russia. And so we were able to trade out quite early on. In our institutional funds, and this is just, so where they stand. In all our institutional funds, we've been able to exit the Russian stocks, except for one pooled fund where they couldn't get it over the line for 2 or 3 of the stocks. So the overall exposure to Russia across all of our products now is minimal. Only one of our pooled funds, the UCITS fund in Dublin, has got a small amount of Russian exposure, but all the other pooled funds were able to exit, and all our segregated clients exited. In terms of the actual impact Russia had on performance, I looked at the figures. From on a rolling 3-year basis, from the time of write down till 3-year anniversary, which was February 2022, the impact was sort of minus 1.5% per annum. So I mean, it's not nothing, but if you're delivering 6-7% alpha and you lose 1.5% because of that sort of stuff, it's not something that makes or breaks your performance history.
Okay, good. Listen, we've had a lot of time. Thanks for your time, Chris, as well. We're going to wrap it up there. Everybody, thank you for joining us. We're going to have another webinar, which is going to be on the 19th of November. That's going to be on retiring. It's actually going to be a 2-part. There's one going to be on the 19th, and then we're going to have a follow-up either the next day or a week later. But we will communicate with you. That's going to be on retirement and all the different aspects about retirement. Essentially, often people just want to know how much money do I really need for retirement and how to do it the most efficiently and the most effectively. Thank you, everybody, for joining us. Suhail, thanks, Chris. We really appreciate your time.
Thanks. He is here. It's just on screen. So.
Okay,
Thanks very much. Thank you. Bye-bye.
Thanks, guys.
Cheers, James.
Yes.
Thanks. Bye, everybody. Thank you.